Bloomberg Audio Studios.
Podcasts, radio, news.
Joining us here at the table is Morgan Stanley Chief U.S. Equity Strategist Mike Wilson. You know, people think of you as a bear also, Mike.
And also very smart, so.
But you're not really bearish this market, are you?
Well, no, we haven't been for the better part of 6 or 8 months. We took our targets up significantly in May, sort of in the idea that we were going to kind of make it through. There wasn't going to be a growth scare that caused a hard landing. And also the Fed. The Fed moved 50 basis points, and then of course we had the election outcome. So we've had a lot of good things that have happened over the course of the last 3 or 4 months. So I would argue the markets have traded that really, really well as they typically get ahead of those things. The question now, and I think we said on this program in October, we said we think we could trade 6,100 on a definitive election outcome, and we got that. So now here we are, 6,100. Do we just revise our numbers higher? No, we think we're on track for 6,500 by end of next year, assuming that things progress the way that we expect. Meaning the base case assumptions we have for our economic forecast for the Fed. That's where the sort of risk is that our forecast on the outcome is not what we expect it to be. And I think this year's next 12 months is going to be just like the last 12 months, where there's uncertainty at times around the growth outcome and the inflation outcome. And
but up 30%.
Well, not up 30, but I mean, the thing is, the last 12 months, we got the earnings forecast exactly right. What we got underestimated was the multiple. And I don't think I was alone in that. I don't recall anyone telling me we were going to trade 22 or 23 times. But then when we get there, everyone just justifies it and says it's okay, we can stay here or even go higher. So look, markets are a little bit diabolical. They trade ahead. And when you're trading the stock market or stocks, you need to think about what's going to be happening in 6 months, not what's happening today. And I think the first half of next year is where the uncertainty probably is going to increase. And then by the second half of next year, things could clear. So it's going to be another, I think, volatile year, plenty of trading opportunity, plenty of dispersion in the stock market. That's what we kind of focus on, what to own, not how much to own. And that's the game. That's the game that we play.
Well, let's talk through some of that volatility, because there's the absolute level, right? 6,500 year-end 2025. It feels like a lot of Wall Street has coalesced around that number. But what does the path to get there look like? What do you see the road being over the next 12 months? So
that assumes that the economy stays sort of, below trend growth, but healthy, sort of 2% real. Inflation continues to climb down, but not, go in a way where it's deflationary. So you have 4.5% nominal GDP growth, which gets you 10% earnings growth. There'll be some operating leverage, and then the multiple comes down a little bit, but not as much as what we would have thought this year. Because look, that's where we are. It's very hard to get the multiple to come down if the Fed's cutting rates and you have above trend earnings growth, and that's what we're forecasting. Once again, assuming soft landing, inflation continues to come down, and the Fed can cut. I would say the biggest risk in that outcome is on the inflation side. We're seeing inflation pick up again because, look, let's be honest, financial conditions are very loose again. Some of that's the market itself. We have now animal spirits picking up because the election outcome, and people are excited. That excitement has a negative consequence, which is that all of a sudden inflation starts to pick up again, and maybe the Fed can't cut. That, to me, is probably the biggest risk to the multiple.
That the Fed can't cut.
As much as people are anticipating.
So, and this may be a driver of that, but wouldn't bad certainty on tariffs, bad certainty on mass deportations, wouldn't that be bad news for the economy and for the market? So,
that's, once again, going back to our view for next year, I think the risks are front-end loaded. We're going to get a lot of announcements. Like I would say the bad stuff comes early. The good stuff from the changeover around the administration comes later, meaning, tariffs and immigration.
But you do think we'll get certainty? Because I feel like it's going to be a little bit like Lucy holding the football, Well, we'll see. Donald Trump loves to play that game. He just pulls it away every time you take a kick.
Well, look, the way policy is made is you float trial balloons, you see how the markets react, and then you're reflexive. That's how I anticipate this to go down. And every time you get one of those sort of trial balloons and then policy actually is made, you get more certainty. That doesn't mean the market's going to like it or love it. It just means we're going to get more information as we go through. He hasn't even taken office yet, So let's give it a little chance here to breathe. I would say, once again, I think that the sort of headwinds for the market are probably early policy changes, and then the good stuff, whether it's deregulation, maybe some government efficiency, maybe tax extensions or even further cuts, comes later in the year. So that's the setup for now, all subject to revision, of course, because there's a lot of other things going on as well.
Yeah, a lot of big ifs there. But I do want to talk specifically about this month. You had a really interesting note out a couple days ago talking about how usually in December you see the small caps lead. That's not what we've seen. The Russell 2000 is actually down about 3% over the past 2 weeks, and it's been big tech that's been in charge. So what is different, and do you see us reverting back to some of those historical patterns?
So I think what happened is, and this happens every year, we get the sort of small cap trade earlier and earlier every year. We also had the election, and we know from 2016's experience that we were going to get a big pop in sort of small business confidence. We since confirmed that earlier this week. That was the biggest increase we've seen in 25 years, small business confidence. So maybe the market kind of pre-traded it. I still think the second half of this month we could see further outperformance from small caps and some cyclicals, just as you kind of mark that up into year end. And then I think you'll get a fade into January, February. That's the way historically the last 4 or 5 years is or 10 years really. You get the small cap trade now earlier, and then you actually fade it at the beginning of the year.
Here's 2 weeks of the major indexes. If you take it out to 5 years, you'll see the Russell 2000 has really underperformed, and the tech stocks, the NASDAQ, has really outperformed. Does that a pattern hold indefinitely? Is this just how it is?
Well, we've had that view for quite a while. We just finally upgraded small caps this summer to a neutral. Like, we're still neutral on that view. I think right now the market is still going to be, it's somewhat narrow. I mean,
you upgraded to a neutral.
We upgraded to a neutral.
We have a viewer writing in who wants to know what made you change your bearish stance. What was it that made you say, okay, you know what? I'm throwing in the towel. We're bold up.
Well, I mean, the data. I mean, basically, I think it was pretty consensus a year and a half ago that the Fed's hiking regime was going to lead to a hard landing, and it never arrived. And there are a lot of, we can go into we wrote a long note about what was different this cycle. Now, to be clear, I don't think the risk of a hard landing has been extinguished. And we're still late cycle, which is why we're trading narrow again. We're trading, people are going for the large cap quality stocks, which is why we don't want to go full overweight on small caps or low quality. We don't think this is the part of the cycle. We're not of the view that this is going to be some big ramp in the next year, that everything's changed, right? It's still a late cycle economy. Rates are still pretty high. We have cost issues with some of the smaller businesses, and most consumers are still struggling. Okay, that's not a kind of environment where small caps or low quality stocks tend to outperform. The one last thing I'll say, though, which is I think a big thing that people misunderstand, is that most stocks, okay, not the big stocks, most stocks do better when inflation is actually accelerating. So if you go back and look at like 2020, 21, and even in 22, the average stock did better than the S&P 500 when inflation was actually accelerating.
Makes sense, though. You want to hold stocks to hedge inflation, right?
And earnings growth is better. So I do think that next year what could happen is we could have a correction in the first half of next year as perhaps inflation comes back. But that's an S&P event. And actually, the average stock may not go down that much. That is an interesting kind of relative value trade that I think people who can do that should be thinking about right now.
Interesting. So maybe a little bit cautious when it comes to the benchmark, but still opportunities to find at the single stock level in that scenario. But I do want to get your thoughts on how the different asset classes are talking to each other, because the bond market has been so volatile, especially if you take a look at the long end. Feels like the stock market, maybe some enthusiasm coming out, but it doesn't necessarily seem to be rates driven. How do you see that relationship evolving in 2025, especially if that big risk comes to fruition and the Fed can't cut as much as expected?
So the rate correlation with equities has flip-flopped quite a bit. And earlier this year, it was quite negative, meaning when rates went up, it was bad for stocks. And now, really since the fall, that's why we pivoted more cyclically. Stocks are now positively correlated to rates. And we think the sweet spot for 10-year yields is 4 to 4.5%. Like in that range, stocks can actually act okay, like as rates go higher. If we get through 4.5, and if term premium starts to increase, which would be concern about inflation, then you're going to see that correlation flip again. So we're, like everybody else, we watch how markets are reacting. It's very reflexive. But we think, once again, that 4 to 4.5% range is kind of a sweet spot.
All right, Mike, it is always great to speak with you, especially on a Friday. Have a great weekend.
Friday the 13th, no less.
Very,
That's right.
Very spooky. It's great to see you.
Thank you.
That is Mike Wilson. He is Chief U.S. Equity Strategist.